the Farmland Exchange, the official podcast of CLHbid.com. Expert insights on buying and selling farmland in Western Canada.
Welcome back to the Farmland Exchange, the official podcast of CLHbid.com, where we provide expert insights into the process of buying and selling farmland in Western Canada. I'm Devon Davidson, your host and digital media strategist for CLHbid.com. If you haven't already, please take a minute to like, rate, and review the show on your podcast platform of choice. It helps us out, and we'd really appreciate it. On today's episode, we are going to be talking about Lifetime Capital Gains Exemption and corporate tax planning with regards to selling farmland. And to help me with that conversation, our Chief Operating Officer for CLHbid.com is Bridget Hennigar. Bridget, how are you?
Good. How are you, Devon?
Good. Thanks for being here. And then we also have a special guest, John Schappert, all the way from Saskatoon, fellow Saskatoonian, chartered professional accountant, practicing tax for about 10 years, and tax advisor for Chan Tax Law. So, John, thank you for being here.
My pleasure.
Really appreciate it. Before we dive into the exciting topic of Lifetime Capital Gains Exemption, maybe tell us a bit about yourself and who you are, how you know the people here at CLHbid.com.
Sure, yeah. I'll try and keep it as brief as possible, but I'm a tax accountant. I've been CPA or CA since 2011, and I articled for a number of years with MMP as it then was, or Myers Norris Penny as it then was. And since that time, I've worked as a CFO and been a tax consultant for numerous law firms, and that's what I'm doing currently. And right now, I'm attending University of Saskatchewan, second year law student.
Nice. What's the best part about living in Saskatoon?
Probably actually how courteous the people are. Like I find compared to Edmonton, it's a much more courteous town. Like people will let you in when you're driving, et cetera. It's great. Yeah.
Occasionally.
Better odds than Edmonton.
I would say, we can't complain with the traffic in Saskatoon. Okay, so Bridget, when people are selling their farmland, what would you say is the most common question that you get regarding taxes?
Well, it always comes up in the conversation, the Lifetime Capital Gains Exemption.
Yes.
Does it apply to me? That's what they ask.
What's the impact? Yeah, well, with higher taxes, people are obviously interested to learn more about the capital gains exemption. So for our listeners who aren't familiar with it, can you maybe give a brief overview of what it is and how it impacts farmers?
Well, it's for eligible individuals, and the Lifetime Capital Gains Exemption provides a deduction, an exemption on their gains that they have selling qualified property. Mm-hmm. And so that Lifetime Capital Gains Exemption is $1.25 million right now. It's a cumulative amount. And so if you have a property sell it for $1 million and the cost base is $250,000, you have $750,000 gain. And that gain would not be taxed. And so it's a significant advantage and something that people are very interested in hearing about.
Yeah.
Now, the whole issue is that what is qualified property?
Right. Yeah. So, John, maybe you want to talk about how farmland sellers can determine if they have QFFP or how they qualify.
Okay. Yeah, absolutely. I think now I'm going to get into the weeds a bit here. So if I get too technical, please do stop me. Okay. But I think it's probably good to start with a few definitions that I'm going to be using over and over again as I talk through this issue. So the first one is something I'm going to call a qualifying person. That's not a technical term in the Income Tax Act, but that's just a helpful term. And that is you, your spouse, your children, and your parents. And when I'm talking about children and parents, children, it's like 3 generations of children down to great-grandchildren. Okay. And then parents, we're talking about 3 generations up to great-grandparents. In addition, your spouse's parents also count as your parents, and they're likewise their parents and their parents above them. And same thing goes with your children. Your children's spouses also count as your children.
Okay.
A couple other nuances, of course, is that adoptive children are considered to be children, as are stepchildren while the marriage persists. I guess I should clarify that for in-law relationships, that only persists, like they're only children or parents so long as that marriage persists. So if there's a death or there's divorce, that's no longer going to continue. But that's qualifying person, just to go back through that again.
Okay.
You've got the individual, that's you, your spouse, your children, and your parents.
Gotcha.
And then we've got another concept here, which is the eligible user. So that's everybody who's a qualifying person. And then you've also got something called a qualified farm corporation, and you've got something called a qualified farm partnership. And I don't want to get into too much of that right now because it's very complex definitions.
Okay.
But that's basically your pool of eligible users. And then the next concept here is this concept of principal use. Okay. So this is kind of a part of every test for capital gains exemption. What it is if you've got a piece of farmland, to say that it is principally used in the business of farming in Canada, that means that more than 50% of its surface area has to be cultivated and used in the farming business. So if you can't pass that threshold, you're never going to meet a principal use test, and you don't have qualifying farm property.
Okay.
The next one is actively engaged on a regular and continuous basis. Mm-hmm. And that again appears multiple times. And the root, what the government is getting at with this definition is they're trying to separate people who are really farming from people who are maybe doing it on a hobby basis, or maybe just, doing it from time to time and it's not a serious source of income.
Right.
And it's a question of fact, which means that you're going to look at all the circumstances that apply that are relevant to the particular question. And I guess the best way to look at it, like CRA's perspective on it, is that you are not actively engaged on a regular and continuous basis unless your efforts towards the farm are kind of critical to the success of the farming business. So if you can't pass that threshold, you're not actively engaged on a regular and continuous basis. Like driving a grain truck once a year is not that, nor is driving a combine once,
Doesn't
right? You have to
qualify,
be, your concontributions have to be integral to the success of the business.
Yeah, I think that's something that a lot of people are unclear about. They think that being an active farmer means paying for the fertilizer. Yeah. And that just doesn't quite cut it. And CRA does have a folio, don't they, of what constitutes active farming and all of the operations that you would be involved in.
That's right. I think it's called What is Farming, but I couldn't give you the folio number or anything like that. But yeah, that's a really good point you bring up. So the other thing that is critical as part of this discussion is what is farming from CRA's perspective. Okay. And like renting your farmland to an unrelated person is not farming.
Right.
Crop sharing, where you're just receiving like profit from the sale of the crop at the end of the day and you've done nothing else, is not farming. It's kind of a continuum that kind of, you get closer and closer to farming, the more risk you're taking in the operation, the more day-to-day involvement you have. And again, how integral your contributions of, we'll say, brain power and capital are to the success of the venture. So those are kind of the 5 definitions. We've got qualified person, we've got eligible user that's got the qualified person, and then farm corporations, farm partnerships, and then we've got principal use, active engagement, and farming business. And so the next part of this is actually the tests that go into determining whether something is qualified farm property. I know you've been waiting for me patiently to get to that.
This is good information.
But I just wanted to get through those definitions because I'm going to give you the tests, and they're embedded, like these definitions are embedded in the tests.
Yeah.
And it's kind of weird to break out, to just go through definitions over and over again. So the first test is usually the easiest one to meet. Actually, I'm gonna take a step back before I get into the tests. The first question you want to ask yourself is, when was the last time I acquired this land? So if you acquired the land before June 18th, 1987, you're into one set of tests. And if you acquired it after June 17th, 1987, you're into a separate set of tests.
Okay.
Now, the key thing with the acquired the land, it's not necessarily when you went on title for the land. It's like, when does the Income Tax Act treat you as having acquired the land? Okay. And there's a nuance there, because in 1994, the old capital gains exemption was phased out. Okay. And so people could, in 1994, elect to use the old capital gains exemption to bump things like farmland. And if you made that election, you're actually treated for income tax purposes as though you reacquired that land in 1994. So if you did acquire it before June 18th, 1987 in an arm's length transaction, because you did that bump in 1994 to crystallize, you're not going to qualify. Wow. So that's pre June 18th, 1987, and then post June 17th, 1987. And I guess I'll go through the pre-June 18th rules first.
Sure.
They're a little bit easier to go through. They're the ones you're definitely more likely to qualify for under if you can pass that first threshold.
Okay.
And that's really either or. So the first prong is, in the year that you sold, was the land principally used in a farming business by an eligible user?
Okay.
And the eligible users, again, is qualifying persons, which is you, your spouse, children, parents, et cetera, right? Like that whole thing. And then, of course, the principal use test, more than 50%. So that's the first prong. And if you can't meet that one, the next one is in at least 5 years while the property was owned by an eligible user, was it principally used in a farming business carried on in Canada by the eligible user?
Yep.
So those ones are by far the easiest ones to qualify. People are always looking to get under that if they can.
Yep.
But because of that 1994 bump and just, it's a long time ago now, it's talking 38 years, like there's a lot of, it's going to become less relevant over time. The second set of tests is for that land last acquired after June 17th, 1987. And the first test there is before the time you're trying to sell, do you have a period of continuous ownership of at least 24 months by a qualifying person? And the continuous ownership part is kind of critical to this whole test, and we'll come back to that later.
Okay.
So that one's, I think, the easier of all the three tests to meet. And then we've got two more tests. The first one is what I like to call the activity test. And that one is in at least 2 years, or I should say throughout at least 2 years during that ownership period we just discussed, like the continuous ownership period, was the land principally used in a farming business in Canada in which a qualified person was actively engaged on a regular and continuous basis.
Right.
And we'll call that the revenue period. And so the second prong that's kind of tied to that test is during that revenue period, so throughout that revenue period, was the gross revenue from farming of a qualified person greater than their other sources of income when combined?
Okay.
So we do end up talking to people a lot about that, being able to perhaps plan their way into that so that they can have those 2 years where their income from farming is more than their other income.
Yeah, and actually a really nice thing about those three tests is that you don't need the same person to meet each one of those tests. So remember, we've got a big pool of qualified persons here.
Yep.
So that continuous ownership test, that could be met by a certain set of qualified persons. Your activity test could be met by another qualified person.
Gotcha.
And then the revenue test actually could be met by a third qualified person. Let's say the person who's more active in the farming business, for whatever reason, maybe they have a lot of other sources of income, and they actually can't meet the gross revenue test. But maybe there's somebody else who does derive farming income, who is, child, parent, et cetera, of the individual who can step in and meet that gross revenue test.
That's interesting. So it makes it a little easier to qualify.
It does make it a bit easier to qualify.
Okay.
So if you fail out on any of those three tests, of course, you're not qualifying unless there's a kind of a fourth test here now. Throughout a period of 24 months during that ownership period we alluded to, did a qualified farm corporation or qualified farm partnership principally use that land in a farming business in Canada in which a qualified person was actively engaged on a regular, continuous basis?
Right.
So that's your final way of getting through. Now, I probably will skip off talking about like the definition of a qualified farm corporation or qualified farm partnership for now, unless you guys think I should launch into that. But
this is the format to do it. So I mean, we've got some time. If you want to dive into it, I think it's probably beneficial for our listeners. But
well, let's get into it then. Let's get into I don't know. Am I too much in the weeds? I hope I'm not too much.
No, we've got time. You know what? I'm not flying out for a while, so let's get into it.
Okay, so qualified farm corporation at a very high level. There's more nuances to it, so I won't pretend that this is the complete definition, but it hinges on what type of property the corporation owns, and is there a shareholder who is a qualified person?
Okay.
And so to be a qualified farm corporation, you basically have two tests, asset value tests. The first one is kind of a point in time, 90% test. 90% of your asset fair market value has to be what we're going to call good assets, and we'll get into what those are. Okay. And then in any 2 years during the existence of the corporation, was more than 50% of the assets good assets again.
Okay.
Or more than 50% of the asset value was good asset value. So what good assets are is any property that's principally used in a farming business. So that could be your fertilizer, grain inventory, combines, tractors, and of course, the most important thing from our perspective is land.
Right.
And in order for land to be considered to be a good asset, again, you've got more tests you got to meet. So going to get through it again. But basically, when you're looking at whether land is a good asset to a corporation, you have to look at the entire period of, can you point to a continuous period of ownership by eligible users? Mm-hmm. And that's going to be our ownership years, we'll say. And that's either ownership or use, actually. So it doesn't actually have to be ownership, but ownership or use by eligible users. Okay. And that's your denominator for what we're going to do here. And then the other question is, out of those ownership years, in how many years was that land principally used in a farming business in Canada by an eligible user in which a qualified person was actively engaged on a regular and continuous basis?
Okay.
There's a lot there. I know.
You're gonna have to draw me a flow chart after this.
Yeah. There's a flow chart's probably required. I should have brought one to the table actually. But for that principal use test, again, it's if it's land, we're talking about how much of the area is cultivated. Remember the active engagement test. It's kind of, are you integral to the success of the farm operation and so on and so forth. So you're going to take all the years where you met that principal use test, sum them together, and then divide them by the denominator of what the ownership years is. And if you're above 50% for 2 years, that's going to meet your 50% test. Okay. And if you're above 90% at the kind of the determination time, we'll say the particular time where you're testing the status, then you're going to meet the 90% test.
So, when we talk to farmers initially, when they contact us, the first thing they're thinking about is selling the land. And they commonly think if it's farming, then it must be eligible. And or there's the other group who think that they're not farming it now, so it must not be eligible. Right. And that's when it's kind of interesting to start asking a lot of questions, all leaning toward all of the check marks that John has mentioned. So.
Yeah. It's more complicated than I had realized. It's not so straightforward, is it? There's got to be a lot of misconceptions.
Oh, there is, and I think I've tried to make the rules less complex than they actually are. I didn't even talk about trusts in this whole situation, or if you're an individual, or if let's say you've got a partnership that's selling land and so on and so forth. But really good point about the questions. Like typically, when we're doing this analysis with clients, what we want to be looking at is we're going to ask them about the full history of ownership all the way back to great-grandparents. Okay. And if there hasn't been any, divorces, you might even be looking at like in-laws up the chain and so on and so forth. So so you're going to want to say, how long did each person in that kind of lineal chain farm, if they farmed at all? And you're going to look at what their source of income were over the farming period. You want to know if it's the main source of income or just kind of an ancillary source of income. And you're going to be questioning just the use of the land year over year over year. And the good thing is farmers love actually to, they know the history of the land. They know how the family's been using it for generations. Yeah. And it's really easy to get that information if you ask.
Okay. Another common misconception would be, well, my father farmed it. Well, your father might have farmed it, and then he passed away and left it to two brothers. Right. And then one brother sells to the other brother. And John, that's an issue. Huh?
That's definitely an issue because, we talked about that concept of qualified persons. Yep. Well, nowhere in that list of qualified persons is your sibling. Siblings are not qualified persons in respect to you, right? It's only your parents up to great-grandparents. It's only your children down to great-grandchildren.
Interesting.
You can't go side from side to side in that lineal chain. So
unless you farm it again by yourself.
Unless you farm it again. So anytime we have situations where maybe paternal grandfather died and passed the land to your father's brother, your paternal uncle.
Right.
And maybe he even farms the land, but then he passes it on to your father doesn't farm, you're not going to be able to use your paternal grandfather's farming use because you had to have that continuous period of ownership with the kind of that qualified person who was your paternal grandfather through to you or through to your father.
Right.
And you don't have that because you have this unqualified person, I'll say, who's your paternal uncle in the mix, just ruining the whole thing. It's a selfish man.
That's awesome.
Yeah.
So Bridget, I mean, farmland owners are probably at least aware of this, but do they ever not realize what they're missing out on with capital gains exemption? Can you explain it or provide a quick example of how overlooking this could impact their bottom line?
Sure. Marginal rates, farmers, as you well know, they don't pay taxes generally. They keep deferring the income onto a future period. And so some of them don't even really have any idea about marginal tax rates and what are the highest marginal tax rates. Here, generally in the Western provinces, it's about 50% at the high marginal rates. And when you're selling farmland, you definitely will exceed those, the highest level. So it's 50%, it's a little lower in Alberta, a little higher in BC. And capital gains, you include half of that amount into income. So effectively, your tax rate would be about 25%. And so if you have a capital gains deduction available of $1.25 million, 25% of that is around $300,000. So it's a substantial amount of money that we're talking. We want to make sure that it's eligible and we want to claim it.
Yeah.
All right. John, how can we involve more family members to get even more savings?
Well, there are practical considerations that come into this. So I urge anybody listening not to just go and start transferring title to various family members right after this discussion. But if it makes sense to do so, you can use the farm rollover rules to transfer title to your adult children. And then they just have to make sure that they hold it for at least 3 years and don't make an arrangement to sell it within those 3 years. And they'll be able to use their capital gains exemption on a future sale that, to be clear, must happen after that 3-year period is over. I think go ahead.
I was going to say, if they don't wait the 3 years, then it's attributed back to the
parent. That's right. So the person who transferred the land to that kid is the one who eats the capital gain on it.
And why 3 years? Why was that the...
It's an anti-avoidance provision. I think they wanted to give parents the certainty that they could take advantage of the rollover rules and not ultimately fall afoul of this provision. But at the same time, they didn't want people to just kind of willy-nilly multiply the capital gains exemption by just transferring whatever the land they wanted to sell that they couldn't sell to their kids.
Right.
And use and having them use capital gains exemption. And the provision that applies here is one that applies very broadly in the Income Tax Act, not just to this situation. But I think it's a relatively fair provision. I hate to say that, but it does make sense.
Okay. And then does it just apply to adult children, or?
So this anti-avoidance provision will apply to any person that you transfer land on a rollover basis to.
You can't roll it over to a spouse. I think that's another misconception. You can sell it to them, or they can buy it together.
That's a really good point. So again, if you want to take advantage of your spouse's ability to use capital gains exemption, you kind of have two pathways. If you've already acquired all this land, and your spouse wasn't kind of really part of that, you really can't add them to title and expect to be able to claim capital gains exemption.
Interesting.
There's something called spousal attribution that causes any capital gains from property you transfer to your spouse to attribute back to you. So that's going to completely deny your ability to do that. But on the other hand, if you and your spouse are part of the farming business together, maybe you have joint accounts, or you're buying the land together, you're both on title when the land's acquired, you're both on the mortgage. I guess you will be anyways, but if you're I guess part of the credit negotiation process, we'll say, then you should be in a good position to have your spouse claim capital gains exemption as well if you sell in the future.
John, there's often confusion about personal and corporate ownership of farmland. Could you clarify how ownership structures differ when it comes to capital gains exemption and tax planning?
I think the biggest difference is probably in terms of who is going to be interested in buying at the end of the day, like the nature of your purchaser. And I guess as we alluded to earlier in our discussion about the qualified farm corporation, you have a completely different set of tests that you have to apply when you're determining, like at a point of sale, whether you're going to qualify or not.
Right.
And just kind of to reiterate very quickly, again, you have this 2-year 50% good asset test, and then you've got, a point of sale 90% good asset test that you got to meet with a farm corporation. Okay. Whereas with land, of course, we have a totally separate set of tests that's hinged around that kind of 2-year period.
Right.
Now that allows for the qualifying farm corporation. Just again, to reiterate that the capital gains deduction or exemption is only available to individuals.
Right.
So corporations, even if they have this land, they can't claim that same deduction. Although if you own the shares of that qualified farm corporation, you can then sell the shares and claim that capital gains deduction.
Interesting. Okay.
Thank you, Bridget. That's I think that's really what Devon was trying to get at.
There's always workarounds, right? That's interesting. Okay.
That,
Thank you for clarifying that. Bridget, are there any other changes in tax law that farmland sellers should be aware of?
Probably one of the points that we maybe didn't mention earlier was AMT, Alternative Minimum Tax. And in last year, they changed the calculation of that AMT, and it's much more onerous on people who are selling farmland and using the capital gains exemption. So quickly, the AMT, the government calculates out what your taxes are on the one hand, and then they add back some of the deductions, apply a flat rate, and get another number for taxes. The difference between the two is alternative minimum tax. And so you must pay that. Now, it can be refundable over the next 7 years. Though for some people, if they don't have a lot of income, they may not be able to actually get it all back. So some planning comes into effect there. You want to make sure you have income in subsequent years to use it up. You don't want to have a permanent tax as such.
Is there maybe just a really quick example you could provide with some numbers? Is that something you can just to illustrate the point?
John, help me out with that one.
Oh my gosh, alternative minimum tax is like financial wizardry, but
if not, we can for sure.
It's how to even get into this. So basically, the way the calculation works is you start with your income as it's normally calculated, and then deductions that you're entitled to, such as capital gains deduction, get kind of prorated away. Okay. In the case of qualified farm property, you have to add back, I think it's 30% of your capital gains deduction, or use capital gains exemption in that calculation. So that gets added to your income. So now your income is bigger than it was under the normal tax calculation. Okay. And then this minimum tax gets applied to that, and you've got a provincial minimum tax on top of the federal one that's a percent of the federal. And so if as a result of that calculation, your tax is greater than it would be under the normal calculation, you pay the higher tax.
So the idea is that the government wants you to pay sort of a minimum amount of tax, no matter how many deductions you have or whatever, okay? Yep. And they're saying, well, we'll give you some of that back if you have taxes to pay in the future. For some, I've done some calculations. They sort of want you to pay like 30% tax, overall. Yep. And remember, I said a capital gain is 25% tax. Yep. So they want a chunk more, and they will refund it if you have income in future years.
Okay, thank you for dumbing that down for me. That's perfect. Bridget, for those preparing for a sale, when would you suggest they start planning for tax strategy and exemptions, and how can CLH help or facilitate that process?
They can't start too soon. Just as John says, they need to have an itemized list of when they acquired all of this.
You can't start too soon in one situation. If you just rolled your farmland to your kid and they're ready to sell, then you can start too soon. But otherwise, I agree.
Good point. So, there's so many factors to ensure that it is qualified property. And also there's a lot of planning. How about capital losses that you might have carried forward? They carry forward forever, but they only are, you can only apply them against capital gains. And so if you have a real dog of share portfolio, maybe this is the time to recognize those losses and get on with life and apply it against that gain. So, a number of concerns. There's also just everyone is specific. There's old age security clawback. So when you have capital gain, then you're likely going to have your OAS clawed back. If you're just turning 65, well, why don't you just defer applying for your OAS? And actually, if you defer applying for your OAS until 70, you actually even get more of an OAS payment. So there's all those kind of things that you can look at. You really need to sit down with your accountant, your tax advisor. Really recommend that you take the time to talk about this whole idea of whether it qualifies or not. And that has a big repercussions on what your total tax will be. They have wonderful tax software, so it's no big deal for them to run 100 scenarios. But if you don't ask them, they don't even know that you're planning to sell it.
Right. Is this something CLH helps with, though, Bridget? Like, if we're working with a potential client, is it something that they can lean on you? I mean, most of them have their own accountants and stuff, right? But if they have questions, is that something we assist with?
We always engage with them and talk to them about these things, but pointing them to their tax advisor, because again, they have all of the history, all of their exact, how much capital gain exemption do they have left? As I say, it's cumulative. So, maybe they don't have a significant amount. What do they expect? How many will they use it in the future? All of these things come into play. Maybe they plan to transfer it to their children. So then the children can use their capital gain exemption. And maybe the parents, it's not as crucial. So all of those factors, what we do is we really point them in the right direction. So often we find that as you get more senior, you have less and less real tax issues. You have a farm and you rent it out. There's really not much there. And so they tend to go to a person who just prepares ordinary tax returns. Maybe they're not getting the whole picture. And I often say perhaps they should pay for a consult. Go to a tax specialist, go to a tax lawyer, lay out your whole plan and talk about it. It doesn't have to be done every year, but just so that you know.
Right. Okay. For executors and beneficiaries involved in an estate sale, what unique considerations should they keep in mind with regards to the capital gains exemption?
I think the biggest one, again, goes back to that first discussion we had about qualified farm property, those 3 tests that we went through. And the first thing they really need to do is get the farming history for the land, and when they do, talk to an advisor to see if they qualify. I think another consideration that often gets overlooked with farmland, even which can be very harmful if you don't do anything about it, is GST. Okay. Especially if you're not selling at arm's length, like if you're passing it down to a new generation, you still have to make sure you're taking into account GST on any transfer of land. Land is never, well, I shouldn't say land isn't ever GST exempt, but usually farmland transfers aren't GST exempt. But otherwise, I think, for estates, the biggest consideration is capital gains exemption, and that determination is really about who in the family farmed, what's the relationship to the beneficiaries, is it a parent, a grandparent, a great-grandparent, and if so, can they meet the 2-year test that we talked about?
I think that's what we find a lot of when we talk to people, is that they miss that capital gains exemption on the final return. And, you can transfer to kids at, the cost base, but then you're losing that $300,000 of tax savings when those children ultimately sell the land. And so sometimes we've actually said, go back to your preparers, get that amended. Right. So that you can take advantage of it. And in some cases, too, we see where it's the reverse. They claimed the capital gain and did not use the deduction because they thought that, they weren't farming just before they passed away. So really, they weren't eligible. So a lot of times, again, we spend a lot of time in conversation talking about all those situations and then seeing if we can point them in the right direction. We want to make sure that they are paying the least amount of tax and maximizing what goes into their pocket.
Okay. Maybe on that note, John, if you want to talk about farmland owners, if they're considering corporate tax planning, what are some common strategies that they can implement while keeping ownership in the family?
That's a good question. Are we looking for like tax deferral or tax minimization? Or are we talking about use of capital gains exemption in the future?
Some people, I think we often say when we want to talk about farmland transition, and we appreciate that family farms are a legacy, and that if that can be promoted and there are people who are interested in it, then make sure that they know all of the ways that they can make that happen. So, that would lead into the rollovers or...
Yeah. I guess, it depends on what the objective is. Like, if you're looking at passing it down to the next generation, then it's usually quite easy to have family farm corporation shares qualify for a rollover to go to the next generation.
Okay.
If you're looking to sell and just, I guess you don't have anybody in the family who really wants to take on farming in the future, then you might want to look at something like what CLHbid does, which is help farmers sell their shares of farm corporations and get the best value.
Okay.
But yeah, those are probably the two main considerations, I'd say.
There's, I think we want to just have you take away that it is complex. And, there are so many situations and variations, and you need to just look at all of the facts that are out there and see if that you can apply and fit into those qualified farm property rules. But, this another, I guess one of the things too I'd like to say is with planning for the future, you mentioned how soon do you plan, but also it's involved in wills. Who gets put on to the will? How are you going to structure it so that the person who is making the will claims the capital gain or has the ability to claim the capital gain exemption as well as the beneficiaries. Okay. So something again to look at.
That's a good point. I think on wills, it's a problem that we see a lot is the mistake of putting multiple kids on the same title for land. Like I understand it's kind of this, it's maybe a fairness concern, but in general, if you do put multiple kids on the same parcel of land, especially if one of them is a farmer and the others aren't, you're likely to have a dispute in the future over the estate.
Yeah.
And you're also likely to have a situation where those kids may not be able to qualify in the future. So
what would your advice be? Because this is a pretty common theme, I think, right? The fairness concern you said. So then what would your approach be?
Well, it's going to be different for every farmer, but something that some farmers may want to look at is selling quarters that aren't maybe contiguous.
Okay.
And using that money to potentially, fund something in the state for the non-farming kids.
Okay.
And then ideally with the farming kids, put them and their spouses on title for whatever parcels are going to be used in the farm.
Gotcha.
Yes, if you have farm corporations too, you know. Again, farmers are so adverse to paying any tax, but perhaps they should take advantage of the lower marginal rates, build up a shareholder's loan, pay that out again, as you say, to the non-farming children, so that the farming children can actually, you know, receive the land.
Right.
So there's a lot of different strategies, and certainly it does take time. If you have a farm corporation, every year you should be talking about how is your journey and what do you see. It's not always going to be straightforward. There may be changes that you make. So that's why it's important to talk to them each and every year when you're getting your annual review done. So
okay.
Yeah, I think another option maybe to consider for most farm corporations aren't exactly flush with cash, but life insurance is also a way to, corporate held life insurance is a good way to provide for non-farming kids and ensure that the kind of the participating shares in the farming corporation go to the farming kids.
Right.
And the reason that works really well is that corporate owned life insurance, you can pay that with dollars that were only taxed at 11%. Versus personal dollars taxed at 48%.
Okay.
The other thing is when life insurance is received by a company, it goes into something called capital dividend account, and then that can be paid out tax-free actually to shareholders.
Interesting.
So what you could do is put the non-farming kids and non-participating shares in the company, earmark the life insurance for them through maybe a unanimous shareholders agreement or something like that. And then for the farming kids, they own the participating shares, but they don't get any of the life insurance. And when the life insurance pays out, gets flowed out, then it's just the farming kids now owning a company that just has land and active farming assets.
That's really interesting, actually.
So, you know, I think the government has provided lots of different legislation to allow for transfer of farmland in families. And I think that's recognition of the value that it brings to the economy. And but at the same time, there may be times, as we talked about, that it just isn't going to work for that to be continued. And that's when you look at the other alternatives.
Excellent. Okay. Well, I think on that note, John, Bridget, thank you very much for being here. This was enlightening. I'll need that flow chart later for sure.
Absolutely. Yeah, I think I've got it in my backpack, actually.
Okay, perfect.
Thank you, Devon.
Yeah, thank you, Devon.
Thanks, guys. All right. On that note, that's going to do it for another edition of the Farmland Exchange. Thank you so much for tuning in. If you haven't already, as I said at the top of the show, please take a minute to like, rate, and review the podcast. We really appreciate it. If you have any questions or topics you'd like us to discuss, or if you are indeed interested in selling farmland yourself, please give us a call at 866-263-7480 or send us an email, info@CLHbid.com. Thanks for tuning in. I hope this was a positive exchange for you. Take care.